The agents moved through the quiet Lexington office with steady steps. It was early morning, and the lights inside Zeke Rewards were still warming up. Stacks of payout folders sat open on desks. A whiteboard near the entrance carried handwritten numbers for the previous day's returns. The room looked like a small company trying to keep up with sudden growth. It did not look like the center of a billion-dollar investigation. They paused at the display screens that looped the pitch thousands had seen. The screens promised daily sharing. The screens showed rising points and fast rewards. None of it matched the bank statements the agents reviewed in silence. Outside, cars from 3 states lined the parking lot. The calls that started this day came from people who believed the company was their chance to climb out of trouble. Some had borrowed money. Some had recruited friends. Many now waited for answers about the returns they could see on screen, but could not reach in real life. The agents knew the next steps would decide how far the damage had already spread. Chapter 1. The numbers that did not fit. The morning the agents arrived, the office on Center Street felt calm. A few employees were settling in. Coffee cups sat half full near keyboards. Screens still showed login prompts. The building felt routine, almost quiet. Nothing in the first few minutes hinted at the reach of the company they were about to examine. They moved through the front hall and into the open work area. Desks held stacks of printed payout reports. Sheets with colored highlights showed columns of daily percentages and point balances. A whiteboard with markers sat on one side of the room. Someone had written the previous day's return number, followed by a short note to update totals before noon. It was the kind of detail found in small offices that were trying to look organized while growing too fast. One of the agents opened a drawer. Inside were folders arranged by affiliate account number. Another agent scrolled through an internal dashboard on an unattended computer. The dashboard showed profit points rising by the second. The numbers climbed with a speed that made no sense to anyone trained in finance. The agents exchanged a short look and kept reading. The office smelled faintly of paper and old carpet. It had the feeling of a company trying to hold itself together during heavy demand. Yet the tension lay just under the surface. Calls had come from participants across states. The calls described delays, locked accounts, and withdrawals that never cleared. The calls also described hope. Many believed the returns would come through once the company finished upgrades or processed backlogs. Those stories were common in the weeks before this morning. To understand the moment, investigators had to look backward. ZeekRewards began as a penny auction site. Users bought bids and used them to compete for items. Each click raised the price by 1 cent and extended the timer. The auctions created excitement for a small audience. But the auction revenue alone was modest. It kept the website running, but it did not create the explosive growth that came later. That growth came from Zeke Rewards. The pitch was simple. Participants could buy VIP bids, give them away to attract traffic to the auction site, and in return receive a share of daily company profits. The pitch suggested a steady return. It suggested a shared win. The company posted daily percentages that made the returns look repeatable. Participants received profit points for every dollar they placed into the system. The more points they held, the larger their share of the daily split. It spread fast. People joined across towns and across states. Many heard about it from friends. Some saw videos online that showed rising balances. Others attended hotel meetings where promoters spoke about opportunity and community and a chance to grow something together. It had the language of a grassroots movement and the rhythm of a plan people wanted to believe in. Inside the office, the team behind the scenes worked long days. Support staff handled thousands of requests. Affiliates wanted to understand how to qualify for higher returns. Others asked how to convert points into cash. The queues grew overnight. The company responded by hiring more staff. Training took time. Mistakes multiplied. Many participants saw delays and thought they were normal signs of expansion. Yet early warnings came from a few analysts who understood structured payouts. They looked at the daily percentages and the promised distributions. They compared those numbers to visible auction revenue. The two streams did not match. Public posts questioned the model. Some users shared those posts. Others dismissed them and said critics lacked understanding. The debate grew. but the company continued to publish daily returns. Around this time, the first regulatory inquiry reached the state office that managed financial complaints. The inquiry was short. It asked why the returns looked consistent, even when auction revenue did not. The inquiry also asked whether the company held a license to offer profit sharing. Staff logged the inquiry and sent a routine letter to the company. The letter asked for documentation. The company responded with confidence and said the model was unique. The case sat open but did not move quickly. Meanwhile, the dashboard inside the office kept climbing. Affiliates posted success stories on their personal pages. Screenshots showed rising balances. Some people said they had doubled their points in a few months. Others said their returns were paying household bills. Those stories drew in new participants. Each new participant brought fresh funds. The model expanded hour by hour. Inside the office, however, the pressure began to strain the staff. A supervisor printed out a report of pending cash-outs. The pages stretched across a conference table. Each line carried an account number, point value, and requested withdrawal. If printed in full, the report would have filled multiple binders. Some staff carried stacks of those sheets between departments because the processing queue had overflowed the software that normally handled them. One employee noted that the number of requested withdrawals had grown faster than expected. She flagged the issue in an internal email. She said the team needed help. She did not say the model was breaking. She only mentioned that delays were rising and participants were growing restless. A week later, a second complaint reached regulators. This one came from a man in South Carolina. He said he had recruited friends and family. He said he had earned points on the dashboard but could not reach the funds. He asked whether the company was licensed to offer the type of return they described. The message carried frustration. It also carried fear. The man had borrowed money to buy bids. He had trusted the plan. Now he was unsure who to call. Regulators forwarded the message to a financial investigator. That investigator pulled early public records. He saw the company claim to share profits from auctions. He compared that claim to auction listings. Sales volumes looked modest. The investigator then watched several training videos produced by promoters. He paused when one video displayed projected daily returns. He wrote down the percentages and the number of affiliates the presenters claimed had joined in the last quarter. The numbers raised concern. The investigator marked the file for further review. Inside the company, staff continued to feel the strain. Support tickets filled the main queue. Some asked about withdrawal delays. Others asked why daily returns shifted without explanation. A few asked whether the company had passed an audit. Those questions were routed to management. Internal messages told staff to reassure affiliates and say the company was processing requests as quickly as possible. The strain inside the office reached a new level near midsummer. Deposits rose sharply. Payout requests also rose. Staff tried to catch up, but they could not keep pace. The backlog created a feedback loop of concern. More affiliates asked questions. More calls came in. Some affiliates tried to withdraw everything at once. The company introduced new rules to slow the withdrawals, saying it would help balance the system. Many accepted the explanation. Others felt uneasy. By this time, state regulators had opened a deeper inquiry. The case moved to a senior examiner. That examiner requested bank statements. The statements arrived with transaction logs that showed money flowing in from thousands of accounts. They also showed rapid transfers out to affiliates. The examiner noticed the pattern. Incoming funds exceeded auction revenue at a scale that made the company's pitch difficult to support. The examiner asked for further detail. The company responded with charts and projections. The charts highlighted growing auction activity, but the examiner saw that the numbers could not fully support the payouts being advertised. The examiner flagged the issue and submitted a referral to a federal partner. The referral moved quietly. No public announcement was made. In the weeks that followed, federal agents reviewed the first set of documents. They studied the business model. They studied the payouts. They noticed the returns barely shifted from day to day. That was unusual. Real business revenue fluctuates. Auction revenue fluctuates even more, but the company posted steady percentages with only slight variance. It was a sign the returns were not tied to real profit. Agents requested internal records. The records showed affiliate deposits growing at a fast pace. They also showed payouts rising at nearly the same pace. Auction revenue remained a small fraction of the total. The agents recognized the structure. It matched a pattern seen in past cases. More calls from participants arrived during this period. Some sounded hopeful. Others sounded worried. One caller said she had shown the return numbers to her church group. She said several members joined because they trusted her. She now wanted to know if the funds were real. The agent who took the call did not give an opinion. He only stated that the matter was under review. At the office, staff continued daily routines. They posted return percentages each afternoon. They updated promotional material. They responded to affiliates who wanted to increase their position. Many staff believed the company would overcome its backlog once new systems came online. They told affiliates to stay patient. But the agents reading the underlying data saw something staff did not. The gap between auction revenue and payout obligations widened each week. The model depended almost entirely on new funds entering the system. The agents documented that pattern carefully. The morning the agents entered the building, they already held enough records to justify the action. They needed to gather the remaining documents, confirm internal communications, and understand how the company managed withdrawal rules. They also needed to check how quickly liabilities were rising. The staff who arrived that day were surprised to see the agents in the main work area. A manager stepped forward and asked to speak privately. The lead agent explained the process. He said they were conducting a regulatory action and needed access to financial and operational records. The manager nodded slowly and led them to a conference room. Inside the room, agents placed boxes on the table. They began collecting printed reports from desks. They photographed whiteboards. They copied files from servers. Staff watched quietly. Some whispered questions to each other. Others called supervisors. Outside the conference room, an agent scrolled through an internal message board. Posts carried routine announcements. One post congratulated affiliates for another strong day. Another post encouraged them to share excitement and bring in new members. The tone of the board felt upbeat despite the rising tension inside the building. As the agents continued gathering material, they noticed the same trend in every record. Points increased much faster than auction revenue. Withdrawals grew at a pace no standard business could sustain. Reports revealed that tens of thousands of participants believed they were earning steady returns. The reports also revealed that only a small slice of funds came from actual sales. The lead agent placed a hand on the stack of documents now filling the table. The team recognized the weight of the evidence. They recognized the scale of the case. What remained uncertain was how widespread the financial damage might be and how many participants had tied their savings to the system. The first phase of the inquiry was complete. The morning light outside had grown brighter. Staff moved quietly around their desks. The agents gathered the last files. They prepared to leave with the material needed to continue the investigation. The question now stood in front of them. If the numbers pointed to a shared illusion, how far had that illusion already spread into the lives of people who believed it would change their future? The next steps would determine the answer. Chapter 2. The proof in the patterns. The first set of interviews began 2 days after the documents left the Lexington office. Investigators sat in a plain meeting room with a long table and a digital recorder. They wanted to hear from participants in different states. They wanted to understand how people became involved, what they believed, and what warnings they had seen. The first interview came from a woman in Virginia. She joined after a colleague at work showed her his rising balance on a laptop screen. And the numbers climbed each day. She said the company encouraged her to buy VIP bids, place them into the system, and wait for daily sharing. She said she believed the auction site produced steady revenue. She admitted she never studied the business closely. She only saw what she called a chance to close the gap between her paycheck and her bills. Investigators noted the details. She said she had withdrawn only a small amount. She said most of her balance remained trapped in points she could not cash out. When the delays began, she assumed the company was overwhelmed. She said she did not realize the delays were a sign of deeper trouble. The next interview came from a retired couple in Florida. They joined after a neighbor hosted a gathering at their home. The neighbor had placed posters around his living room showing return percentages. He said he had earned more in 3 months than he expected in a year. The couple trusted him because they had known him for more than a decade. They said they bought in with savings from a small pension. They believed the returns came from auctions that were growing in popularity. They told investigators they tried to review the company's public statements. They said the material looked professional. They also said they never received documents explaining the full structure of the payouts. That absence did not trouble them at first. They assumed the plan was legitimate because so many people around them had joined. The room grew heavier as stories continued. Each story followed a similar shape. A friend or colleague introduced the opportunity. A chart or video showed rising balances. The participants believed they were receiving a share of profits. They believed the company had found a new way to distribute revenue from an online business. Investigators compared the interviews to the documents from the office. The stories did not match the data. The auction site produced some revenue. It did not produce enough to support the daily sharing totals shown on the internal logs. The logs recorded payouts that far exceeded the money entering from auctions. The shortfall grew each week. A forensic accountant joined the team to review the streams of transactions. He traced the flow of funds through company accounts. He noted how money from new participants entered one account. He noted how payouts left another account only hours later. The pattern repeated day after day. He wrote a short report summarizing his findings. It stated that the majority of funds used for payouts came from new participant deposits. That statement was based on verified bank data. That finding marked a turning point. Up to that moment, investigators had considered the possibility that the company simply misreported its auction revenue. But once the flow analysis showed a dependency on new deposits, the case changed direction. The team now needed to understand whether leadership knew the imbalance existed and how they handled warnings from inside the company. Investigators reviewed internal communications. Some messages were routine. Others mentioned concerns. One employee wrote that auction activity remained flat while affiliate deposits climbed. Another employee asked whether it was wise to promote daily returns without a stronger source of revenue. These messages did not accuse anyone. They simply showed signs of doubt that did not reach the public. The team visited the Lexington office again to gather follow-up material. This time, they requested access to server logs and payout algorithms. A technician explained how the system calculated daily percentages. He said the percentage came from a formula entered by management. He said the formula was not tied directly to real profit. He said the number was chosen each day based on what leadership considered sustainable. That statement drew the attention of the lead investigator. If the percentage came from a chosen input rather than actual profit, then the pitch to participants differed from the reality of operations. That issue moved the case closer to a critical threshold. Investigators asked for interviews with executive staff and top promoters. Some agreed to speak. Others requested legal representation. The interviews that took place followed a careful script. Each person described the organization as fast-growing. They said the delays were caused by expansion. They said the returns were based on company success. But when investigators asked for clear sources of revenue, the responses shifted. Some mentioned advertising. Others mentioned secondary markets. None could show verified revenue numbers large enough to support the daily totals promised to participants. One promoter said he believed the company would stabilize once new software launched. He said he had never questioned the daily percentage because he trusted leadership. He also said he did not know how the formula worked. He learned his script from training sessions and repeated it at events. The investigators documented these statements word by word. During this period, digital forensics specialists reviewed server data. They looked at transaction logs, account creation patterns, and payout timestamps. They noticed automated scripts that issued points to accounts each day. They noticed how the totals increased regardless of auction activity. They also noticed that some internal accounts held large point balances that did not come from real sales. These findings supported the financial analysis from earlier reports. The midpoint of the investigation came when the team compared the total liabilities to the total assets. Liabilities referred to the points and promised returns recorded in the system. Assets referred to the money held in company accounts. When the numbers were placed side by side, the gap became impossible to ignore. The liabilities exceeded assets by a massive margin. The amount owed to participants, based on their point balances, far exceeded the funds available to pay them. That comparison represented proven, documented fact. It became one of the most important pieces of the case. When investigators brought this finding to leadership, the responses varied. Some executives said the model was misunderstood. They said the points did not represent real liabilities. They said the points simply measured participation. Investigators challenged that explanation by showing internal training videos where promoters explained points as units of value that could be converted into cash. Those videos had been used to recruit thousands of participants. They showed the company presenting points as something with financial meaning. During one interview, an employee made a statement that shifted the tone in the room. He said the team had known for months that withdrawals were rising faster than auction sales. He said they adjusted daily percentages to control the flow of payouts. He said they hoped the auction platform would expand fast enough to catch up. His words did not accuse anyone of criminal intent, but they showed awareness that the model depended on new funds entering the system. Investigators included this statement in their internal summary. It helped clarify the divergence between public claims and internal realities. As interviews continued, letters from participants arrived in the mailroom. Some letters described belief in the company. Others described fear of losing savings. One letter came from a woman who said she invested out of trust in a friend. She wrote that she had used her emergency savings to buy bids. She wrote that she had encouraged her sister to join. She wrote that neither could withdraw funds. The loss weighed heavily on her. Investigators added the letter to the growing archive. The team now prepared a deeper financial breakdown. The forensic accountant created charts showing revenue from auctions. He created charts showing deposits from new affiliates. He created charts showing the daily payout totals. The contrast across the charts was striking. Auction revenue remained small. Deposits rose quickly. Payouts followed the same rising line as deposits. The charts illustrated the structure with clarity that no statement could replace. When supervisors reviewed these charts, they asked for verification. The accountant showed the underlying bank statements. Every line of the charts came from verified records. The supervisors signed off on the findings. The next phase of the investigation involved comparing statements from leadership to internal data. Investigators prepared a binder with quotes from public events. Leadership had told audiences that the company shared profits from strong auction performance. They had said the system rewarded participation. They had said the platform was expanding into a major online presence. Investigators opened the binder of internal data beside this binder of public statements. Page after page showed the mismatch. The returns participants believed came from auctions had, in fact, come from new participants entering the system. The internal data supported this conclusion without exception. The team moved to draft the core finding. It stated that the operation depended on incoming funds from new participants to pay earlier participants. This finding was based on bank records, internal logs, payout histories, and testimony. It represented a proven structure. With this finding in hand, investigators prepared for the next step. They needed to determine when the company became aware of the imbalance and whether they continued to promote daily sharing after recognizing the shortfall. More internal emails helped fill this timeline. Several messages from mid-year asked for caution when advertising daily returns. One message said the company needed to reduce expectations. Another message warned that participants were becoming frustrated with withdrawal delays. Leadership responded by changing certain withdrawal rules. These changes reduced the amount affiliates could cash out at once. They also encouraged affiliates to keep points in the system. The investigators wrote that these changes slowed withdrawals but did not address the underlying imbalance. Each month, the system owed more than it could pay. Points continued to rise, auction revenue remained low. As the team refined its findings, more participants requested interviews. Some wanted to understand whether their funds were lost. Others wanted to provide documents that might help the case. Investigators handled each interview with care. They documented facts only. They did not offer opinions about the future of the case. One participant from Texas showed investigators a binder of printouts. He had tracked his daily points, he had tracked his deposits, he had also tracked his referrals. He believed the system worked because the numbers always grew. The investigator pointed to the column that showed actual withdrawals. The participant realized the total was a small fraction of his balance. He sat quietly for several minutes and then asked when he would know more. The investigator said updates would come once the case reached its next stage. By this point, the evidence had formed a clear line. It showed the structure of the model. It showed the imbalance between revenue and obligations. It showed the dependency on new money. It showed leadership promoting daily sharing despite internal concerns. It showed rules that slowed withdrawals. It showed participants who believed the system would help them overcome financial strain. The chapter of escalation ended the moment investigators delivered their full financial report to federal supervisors. The supervisors reviewed the findings. They asked questions about revenue sources. They asked questions about liabilities. They asked questions about the timing of warnings. They asked whether the company could reverse its trajectory. The investigators answered each question using only verified data. The supervisors agreed the case had crossed into a critical phase. What remained uncertain was how fast they needed to act. If the company continued taking deposits, the gap would widen each day. If they delayed action, more participants would join. If they moved too soon, they risked misunderstanding the scale of the model. The decision held weight because thousands of people had placed their savings into the system. The team prepared a briefing for next steps. They summarized the findings in plain language. They showed the charts. They described the interviews. They outlined the risks. The closing line of the briefing asked the question that shaped the next stage of the investigation. Now that the model depended on new money to pay old obligations, could regulators intervene in time to stop the damage from spreading further? The answer waited in the next phase. The case was no longer about understanding the imbalance. It was now about stopping it. Chapter 3, The Collapse and the Count. The briefing reached federal supervisors before sunrise. The evidence filled several binders. Each binder carried charts that made the same point from different angles. The liabilities of the system had grown beyond its actual revenue. The promised returns to participants far exceeded the company's assets. The investigators stood by this conclusion because every chart came from verified records. The supervisors met in a secure room. They read the binders page by page. They asked the same questions several ways. They wanted to know whether the model could pay its obligations without new deposits. Each time, investigators pointed to the same numbers. The system could not sustain itself. The only steady source of funds came from incoming money. That fact shaped the path ahead. The supervisors called for a full review of legal options. Attorneys in the room studied the findings. They looked at the timeline of participant complaints. They looked at internal communications showing concerns about payouts. They looked at charts showing the widening gap. They discussed whether the company had made public claims that differed from its internal data. The attorneys confirmed that the evidence supported emergency action. Once the decision reached a clear threshold, the supervisors approved the request for an emergency shutdown order. It would prevent the company from taking more money while the investigation continued. That order required coordination among teams, including agents who would serve the documents and secure the office. Preparations began immediately. A team reviewed the company's known locations. Another team requested updated server access from digital forensic specialists. A third team prepared statements that would be released to the public after the shutdown. The language had to be accurate and clear. It had to protect participants from further loss. Inside the Lexington office, staff members continued their routines. They updated the daily return percentage. They answered support tickets. They prepared promotional material for an upcoming affiliate event. They did not know regulators were preparing to intervene. The office felt busy, but not panicked. The staff believed they were managing a large operation with normal growing pains. The next morning, federal vehicles lined the parking lot once again. This time, the visit carried a deeper significance. Agents walked toward the entrance carrying sealed envelopes. A manager recognized them from the earlier visit. She stepped forward with caution. The lead agent greeted her. He said they needed to speak in a private room. Inside the conference room, the lead agent placed the envelope on the table. He said the document authorized a full shutdown of the operation. The manager opened the envelope slowly. Her face tightened as she read each page. She asked if this meant the company had to stop taking deposits immediately. The lead agent said yes. She asked whether they could continue processing withdrawals. The lead agent said no. The order required the company to pause all financial activity. The news traveled through the office quickly. Staff lowered their voices. Some asked whether they would lose their jobs. Others wanted to know what would happen to participants who had money in the system. No one had answers yet. The shutdown order marked the beginning of the next phase, not the end of the case. Agents began securing the building. They photographed all workstations. They collected computers, folders, and whiteboards. They disconnected network cables and placed servers into evidence containers. They moved with steady precision because the timeline required it. They could not risk losing any data. While the agents gathered material, leadership arrived one by one. Some looked surprised, others looked resigned. None tried to interfere. They asked to speak with investigators privately. The lead agent arranged a short meeting. During that meeting, leadership asked whether the shutdown meant the company had been formally charged. The lead agent said the shutdown prevented further harm while the investigation continued. It did not represent the final outcome. More evidence would be reviewed. More interviews would take place. Leadership listened quietly. Outside the conference room, staff watched with unease. Some employees held boxes with personal items. Others waited for instructions. The shutdown created uncertainty, but investigators needed the space to complete their work. Once the building was secured, attorneys prepared the public statement. The statement explained that regulators had taken emergency action. It said participants should stop sending money. It said the investigation was ongoing. It said more information would be released in the coming weeks. The statement reached thousands of people within hours. Many participants were shocked. Some said they had trusted the company with their savings. Others said they had believed the daily percentages represented profit. Some posted messages asking whether they would ever recover their funds. Investigators monitored the responses, knowing the uncertainty would spread fast. The next stage involved building the formal case. Investigators reviewed every document gathered from the office. They compared internal numbers to public claims. They mapped the timeline of deposits, payouts, and internal warnings. They studied the decisions that slowed withdrawals. They studied how leadership continued promoting the system even after internal staff noted problems. One of the clearest findings involved the daily return percentage. Internal files showed that the percentage was chosen based on management judgment, not actual profit. Public statements had described the return as a share of company profits. The mismatch became a central part of the case. Another key finding involved liabilities. The system recorded billions of points owed to participants. The investigators confirmed the real funds available were only a fraction of that amount. The promised value of points did not match the company's financial reality. These findings shaped the final report. The report outlined the structure of the operation. It stated that payouts to earlier participants came primarily from the deposits of newer participants. This conclusion came from bank data, server logs, and financial analysis. The report identified the model as a pseudo-Ponzi structure based on proven characteristics. Once the report reached supervisors, attorneys drafted the charging documents. They outlined the legal violations supported by evidence. These included the sale of unregistered securities and misrepresentations about the source of returns. The attorneys presented the charges to federal prosecutors. The prosecutors reviewed the case and approved the filing. Public announcement of the charges created a wave of reaction across states. Thousands of people tried to understand what the findings meant for their savings. Many had believed they were part of a legitimate profit-sharing program. Others said they had trusted leadership because they saw consistent returns on the dashboard. Investigators knew the impact would be significant. A receiver was appointed to manage the remaining assets. The receiver's job was to collect money, sell assets, and return as much as possible to participants. The process required careful documentation. The receiver created forms for participants to submit claims. He reviewed thousands of records. He identified which transactions qualified for recovery and which did not. The task was slow. Some participants had reinvested their returns immediately. Others had withdrawn small amounts. The receiver needed to determine each person's net position. That required tracing money through the system month by month. Many people learned they would recover only a small percentage of their total balance. The news weighed heavily on communities that had joined together. During this period, former staff members provided additional interviews. Some expressed shock at the size of the liabilities. They said they had not seen the full financial picture while working there. They said they believed the company would eventually stabilize. They said they did not realize the model could not sustain itself. Other staff members said they noticed problems earlier. They pointed to internal messages where employees raised concerns. They said those concerns were not addressed. These statements helped clarify the internal timeline. Leadership faced charges supported by documented evidence. Prosecutors emphasized the difference between public claims and internal data. They presented bank records showing the flow of funds. They presented server logs showing automated point inflation. They presented communications where staff expressed concerns about sustainability. The evidence formed a complete picture. In the outcome, leadership accepted responsibility for the operation of the scheme. They agreed to restitution and forfeiture terms. They faced sentencing based on proven violations. The court recognized the magnitude of the financial harm. It also recognized the need for a long recovery process. The aftermath reached far beyond the courtroom. Communities across states felt the impact. Some participants faced financial hardship. Others faced strained relationships with friends they had encouraged to join. Many felt anger. Many felt disappointment. Some said they struggled to understand how the system grew so large before intervention. Investigators delivered public briefings to explain the case in clear terms. They described the structure of the operation. They described how returns were not tied to real profit. They described how payouts depended on new deposits. They encouraged people to be cautious with online investment programs that promised steady daily returns. They said real companies experience fluctuation. They also said one lesson stood out. When a system promises consistent growth without showing clear revenue, it deserves scrutiny. That statement became part of the final report. The receiver continued returning funds for several years. Each payment represented a fraction of what participants expected. The process required patience. It also required trust that the system would return everything it could. As time passed, investigators reviewed the case at a final internal meeting. They noted that the model grew because it matched a common hope. People wanted a path to financial stability. The system offered that promise on a screen that updated every day. The promise looked real until the numbers were tested. The meeting ended with a final observation. Digital platforms can grow quickly. They can reach thousands of people in weeks. When trust moves faster than verification, the risk grows faster than anyone expects. The collapse of the company was complete. The facts were fixed. The losses were counted. The investigation closed. The story left one question behind. In a world where online opportunities spread faster than warning signs, who will recognize the next set of numbers that do not fit?